This is Tyler Braun, Senior Financial Advisor with the Tranel Financial Group. I hope you're having a great day. I wanted to take just a quick moment and talk about some of the volatility that we've been seeing, over the past few weeks and even year to date in the markets. What I've been sharing with many clients is it really comes down to two main items with the economy, and that's inflation and interest rates. And then more recently, we've seen a lot of volatility creep in with the Russia and Ukraine issues that have been coming to the forefront. So let's unpack some of these just item by item to get a better understanding of what we're looking at and how we can get ahead of some of this going forward. So, number one is inflation, right? Inflation is simply a term for the cost of goods and services going up. And we've seen in a lot of indications inflation increasing anywhere from 8 to 11% year over year. So in simple terms, that simply means that if inflation's up by 10%, right, you're able to purchase 10% less with the same amount of money as you were the year prior, right? So what that does is it impacts spending. So the economy is driven by consumer spending, right? People going to the store and purchasing items. And if those items cost more money, you can afford less of those items, and it starts to take a hit on that bottom line for corporations, right? So the way that we're seeing inflation and the way that we're seeing it rise, most people are saying, well, how did we get here, right? What factors went into this? And a lot of it has to do with the pandemic. So think of the amount of stimulus as a nation we have infused into the economy over the past 12 months, even 24 months now, as we've gone through the pandemic, right? We've had stimulus checks go out. We've had forbearance on student loans. We've had forbearance on mortgages, moratorium on evictions. We had the Child Tax Act, where we were putting $300 per month per child into qualified individuals' hands. So what that did is it increased the amount of money that people had on a monthly basis, and they spent that money and they bought things, right? And that drove the economy further. So ultimately, what we've seen going forward is we've seen spending increase, but at the same time, we had the largest disruption in supply chain ever, right? COVID came in and shut down ports. We have a labor shortage. We can't get the inventory off the ships and onto semi-trailers fast enough to even get it to the retail public. So that remaining product that's available has to go up in price. And that's exactly what we've seen. And we've seen it start to tick up pretty exponentially. So inflation is definitely something that we're watching. One thing that we continue to monitor with inflation is you want to focus on companies that you have to purchase their product regardless of the price that they cost, right? So think about it. When's the last time you got to negotiate your utility bill, right? Never, right? They bake the profit margin into the price that they're charging you. And that really is something that you have to rely on. A way for the Federal Reserve to help curb inflation is they increase interest rates. And that's the second piece that I want to touch on is we're going to most likely see rates start to increase throughout 2022 and then possibly beyond. So most people say, how does increasing interest rates hedge or slow inflation? Right? And what that means is that if we see interest rates increase, what that means is when the Federal Reserve is increasing those rates, all institutions will start to charge more interest to the end consumer. So credit card companies, for example, will increase the minimum interest they charge. Student loans, mortgages, car loans, et cetera. We start to see institutions charge more interest. You put yourself in that average American shoes, you might have $10,000 of credit card debt, some student loans, different things that you're paying interest on. If you're paying more interest to the institution going forward, you have less cash flow left over to buy other products. So your desire or demand to purchase things comes down, and it allows the inventory to catch back up. Right? So in a normal supply or economic standpoint, the demand for the product comes down and the supply chain can catch back up. Well, what we're watching is we still have to deal with COVID, and we still have a labor shortage, and we still have supply chain issues. So even as interest rates rise and the demand to purchase things might come down, it will still be a slower effect or impact that we have to monitor going forward to get this pipeline worked out, to get that product to the end user. Okay. So similar to what we had talked about before, we want to focus on companies that you have to have their items or need their product. So put yourself in the shoes of an American family, right? Cash flow was comfortable. You received some stimulus, you started to spend some extra cash flow. All of a sudden, you're noticing that you have less money left over at the end of each month because inflation or the cost of things that you purchased has gone up and it continues to go up. And all of a sudden, you see interest rates start to rise and you're paying more money towards your credit cards. Now cash flows become even tighter. If you want to go on vacation, right, you're going to think twice of going on that vacation because things are very expensive and it's not something you have to have. It's not a necessity. So you're going to put that off. They call that cyclical, right? Ultimately, you still have to pay your utility bill. You still have to pay your light bill. You still have to buy food. If you have a baby, you have to buy diapers, right? If toilet paper goes up $1 a roll, you're still going to buy that item. Those are the companies we want to continue to focus on going forward to help us get through this inflationary time period. All of that being said, we're now dealing with some Russia and Ukraine, hostility. We're seeing volatility that's created by something that ultimately we don't have any control over, and that can create unrest and volatility in the market. When we look at that, most people are saying, how are we related to this? How are we connected? Just remember, it's a global economy. We import a lot of our oil and products from Ukraine and Russia, from that region. So if we see war break out, that means we're not importing those products. We're going to be sanctioning in some capacity Russia by what they've laid out already in their plans. And if we do that, most likely we could see oil prices and gasoline increase. And what that does is it means if oil or gas jumps up to a higher price than it is today, that's a bigger expense for the American people to carry, which drives inflation up further. So we're all connected in this when we hear it. Just know there's always going to be some type of political issue. There's always going to be some type of event that's out there, and we have to continue to stay long term. Remember, if you're invested in good, solid companies going forward, they're going to continue to produce over time. And that's what we have to focus on. Many of you are holding those what we call recession-resistant type sectors or inflationary-resistant type sectors. And they're basically companies that continue to do well and companies that you continue to have their product regardless of what's occurring in the marketplace. And that's where we want to continue to focus. Dividends and yield, right, become very important as well to reinvest in dollar cost average through times of volatility, which many of you are also taking advantage of. So if you have any questions, please feel free to reach out to us directly, right? I'm glad to sit down. I'm glad to have a phone call. I'm glad to walk through any of the specifics with your portfolio or any questions that you have. But ultimately, just note that we want to continue to focus going forward to ultimately put you in the best position to manage the inflation, to manage the rising interest rates, and to continue to have success through all of this noise that you're hearing. So you're going to have a bigger, more impactful future. Thank you.